Hi everyone and welcome to another JH Law video. Today we are discussing capital raising. So capital raising can be a totally exciting venture, although with increasing calls for transparency and compliance, it can be a little bit uncertain as to how to proceed, particularly for businesses who are raising capital for the very first time. So, thought it might be a good idea to list out 5 general steps to a typical capital raise. So let's get into it. Step 1. What is your purpose? So this is figuring out, what does your business need the capital for? Is it A, are you wanting to purchase a specific asset or a piece of land? B, perhaps you are wanting to invest in talent, bring on new specialist people to develop or market your existing or new product. Or 3, perhaps you're wanting to bring in some experienced investors who can offer your business both capital and expertise, and perhaps help with attracting business from people who like to see big names backing your board of directors. So step 2, determine your structure. And what I mean by that is, what entity is the investor going to pay funds into? And you'll probably say to me, Janie, wouldn't they just pay into the company that I'm currently trading in? And sometimes, yeah, it would be that company. Although, after discussion with your IP, tax and other legal advisors, you might find that it's better to create a new special purpose company or limited partnership or other managed investment scheme that is more appropriate for investors to pool their funds there. It's good to have all your various advisors aware of your efforts to capital raise, just so that they can spot any holes in your offer and deal with them quickly and efficiently. So we're up to step 3, and this is where we can start documenting. Yay! There's lots of different document sets or offer document sets that one can put together, but I've kind of just drilled it down to 3 key ones. These 3 documents include your investment agreement, your information memorandum, or IM as they say, and 3 is your governance agreement. So it could be a shareholders agreement or limited partnership agreement, depending on which structure you pick. And without needing to delve deep into each of these 3 different documents, it's important that all 3 marry up. They should be consistent. So the investment agreement is typically a short 3 to 5 page commercially friendly contract. It's where the investor gets to write down who they are, how much they're willing to invest, and when they'll invest, and any checks or conditions that them or the business need to meet before they'll actually transfer funds. Secondly, the IM, or the Information Memorandum. Now this document, although not always compulsory, we do see the IM being increasingly used and becoming a market standard. It is a terrific marketing document and essentially addresses the who, what, when, why and how. Who is on your team? What do you need the capital for? Why do you need investors? When do you need the funds? And how do you plan to meet expected target returns to investors? And it's this latter question, this how returns, that the investors will understandably want to know a little bit more information about. More than likely, a prudent investor will want to drill down into the financial section, and basically the numbers that you present in this section of the IM will ideally want to tell a very clear story, a clear breakdown of how you reach your expected target return to investors that you've been marketing across media. So a very important section indeed. And thirdly, the governance agreement. So this could be your shareholders agreement or your limited partnership agreement, depending on which structure you choose. This document is a bit larger. You'd probably expect to see maybe anywhere between 30 to 60 pages. And you may ask, why does this one need to be so much longer than the IM when the 2 should really marry up? And a key reason for that is the contract really delves into processes. So In the event an investor wants to exit or transfer their shares or units, they will look to the contract where it will clearly record the details of who do you write to, when do you need to write to someone, how long do typical transfers take, that sort of thing. So it is processes like these that you don't really need to delve into the marketing document. So we are up to step 4, and that is ensuring FMCA compliance, a hugely critical step. And I won't say it's the most important one, but it is. I think all these 5 steps are important, but this one definitely sticks out to a lot of people proposing to capital raise. So the Financial Markets Conduct Act 2013 is a beautiful 478-page piece of legislation. The whole purpose of it is to promote transparency across New Zealand's financial markets and also protect retail investors, so your mum and dad type investors, and making sure that they get sufficient disclosure or information on deals before they actually agree to invest, which is fair enough. So if your offer is actually only open to wholesale investors, which a lot of private offers are, you are actually exempted from providing full proper disclosure, although there will still be certifications to get from your wholesale investors. There are about 10 different types of wholesale. You could be an investment business, a large person, a government entity, and there are also those investors who are kind of on the brink of being a wholesale investor. You know, they don't quite trade in securities day to day. They've had previous grounds of investment experience before, and as long as their accountant, financial advisor or lawyer can also sign off confirming their grounds of investment, then they will be what is known as an eligible wholesale investor and allowed to proceed with the offer under the Act. Right, and the last step, step 5, and that is to sell it well. So sometimes businesses will complete steps 1 to 4, create beautiful documents and kind of just pass them off to potential investors and wait. With experience, the most successful capital raises that I've seen have dedicated a huge amount into the sales and marketing side of things. They've not only just distributed, they've also followed up, engaged, responded quickly to questions again and again and again, communicated that sense of urgency, and those efforts have totally translated into successful capital raises. So whether it is you as a business owner who communicates with potential investors, or you train your marketing and sales team to be the front line, whoever communicates with investors needs to really understand your documents well, be able to communicate them clearly, and also engage and respond to investors quick smart. So there we have it. 5 typical steps to a capital raise, and of course you'll be able to tell that these are relatively high level just for the purposes of this video, and it will totally pay to really flesh out each of these 5 steps with your advisors. He's ready to go. But it'll really pay to flesh out these 5 steps with your advisors, perhaps roundtable style or Zoom gallery if we have to.